What if I told you that one piece of paperwork sitting in a drawer right now could cost your children £60,000? And what if I told you that fixing it takes 20 minutes and costs nothing at all? Before we go any further, do me one favor. Hit like on this video right now, not at the end, right now, because the algorithm needs to know early that this matters to you, and it decides in the first few minutes whether to show this to anyone else who needs to hear it. Then subscribe, because I'm going to be covering these rules as they change, and they are changing fast. And if you know a couple in their 60s, 70s, or 80s, send them this video today, not next week, today. Because for some families, the gap between "I'll get round to it" and "it's too late" is measured in months, not years. My name is Sandra Wells. I spent close to 35 years working inside trust and estate departments in this country, helping ordinary families work through what happens after a death. Not the wealthy ones with offshore trusts and private bankers, ordinary families, a house, a pension, some savings. The kind of estate almost everyone watching this video actually has. And here is the thing that used to frustrate me more than almost anything else in my career. A married couple in Britain can legally pass up to £1 million to their children without HMRC taking a single penny. That is not a loophole. It is not aggressive tax planning. It is written plainly into the law, available to nearly every married couple in the country. And yet most families never get there. Not because they are reckless, not because they don't care, simply because nobody ever sat them down and explained in plain English the 4 things that need to be in place before the first spouse dies. By the time most people learn what went wrong, the first spouse is already gone, and some of these mistakes cannot be undone after that point. So this video is not theory, this is the list. 4 assets, 4 things to check, and 1 date in 2026 that should be on every couple's calendar. Let's start with the asset almost every couple owns, the one everyone assumes is already sorted, and the one that quietly catches more families than any other: the family home. Here is what most people get right. When the first spouse dies and leaves everything to the survivor, including the house, no inheritance tax is due, none. There is a complete exemption in UK law for transfers between spouses and civil partners, no matter how large the estate. So if your husband or wife passes everything to you when they die, HMRC does not touch it. That part genuinely works the way people assume it does. The trouble begins at the second death, and this is where I watched so many families lose money they never needed to lose. Every person in this country has a nil rate band, an amount they can leave free of inheritance tax. Right now, that figure is £325,000. When the first spouse dies and leaves everything to their partner, none of their own nil rate band gets used up, because nothing taxable actually passed. The law allows that unused allowance to transfer to the surviving spouse. So when the second spouse eventually dies, their estate doesn't just have their own £325,000 allowance. It has both, £650,000 combined, tax-free. Now stack a second allowance on top of that. It's called the Residence Nil Rate Band, brought in back in 2017, and most people I spoke with had never heard the term in their life. It is worth up to £175,000 per person, and just like the standard allowance, it transfers to the surviving spouse if unused. That's another £350,000 combined. Add it all up, £650,000 plus £350,000. A married couple can potentially shelter £1 million from inheritance tax, the family home included. But there's a catch, and it's the catch that quietly costs families tens of thousands of pounds every single year. The Residence Nil Rate Band only applies if the home goes to direct descendants. Children, stepchildren, grandchildren. Not a brother, not a niece, not a lifelong friend who's been like family. Direct descendants only. Let me show you what that actually looks like in real money, because the difference is bigger than people expect. Picture a couple. We'll call them Walter and Margaret, both in their early 70s. Their house is worth £600,000. They've got savings and investments worth another £200,000. Total estate, £800,000. Nothing unusual here. Just a couple who worked, saved, and watched their house grow in value over 4 decades. If their wills are written correctly, directing the home to their children on the second death, their combined tax-free threshold is a full £1 million. Their estate is £800,000. Inheritance tax owed, 0. Every penny goes to their children. Now picture the same couple with outdated wills that never properly address the Residence Nil Rate Band, or wills that leave part of the estate somewhere other than direct descendants. Their combined threshold drops to £650,000. The estate is still £800,000. That means £150,000 is exposed to inheritance tax at 40%, £60,000. Gone. Not because Walter and Margaret did anything wrong with their money, because of one document that was never updated. Same couple, same house, same savings. The only difference is a piece of paper. That is the entire gap between £0 and £60,000. And there's a second trap hiding inside this one that almost nobody knows about. The transferred allowance is not automatic. Somebody has to actively claim it. The executors of the second estate must file a specific form, the IHT 402, alongside the main inheritance tax paperwork, and they must do it within 2 years of the end of the month the surviving spouse died. HMRC will not remind you. They will not chase you. If that window closes, the allowance is lost completely. No appeal, no exceptions. 2 years sounds generous until you remember what those 2 years actually look like. Grief, funeral arrangements, paperwork piling up on the kitchen table, family members not speaking to each other about money because nobody wants to seem cold. 2 years disappears faster than people expect. So here is the one question worth asking a solicitor, even if it costs you an hour of their time. Does our current will make sure the residence allowance is fully available to whichever of us dies second? If they say yes immediately and clearly, get it in writing. If they hesitate even slightly, that hesitation is worth chasing down. Now the second asset, the one that genuinely shocks people when I explain it. The ISA. Most people believe that because an ISA is tax-free while you're alive, no income tax, no capital gains tax, it must also be invisible to HMRC when you die. It isn't. That tax-free wrapper protects your money while you're living. It disappears the moment you die. The full value of your ISA becomes part of your taxable estate, just like your house or your savings account. If your estate is large enough that ISA money faces the same 40% as everything else above your allowance. The only reason this doesn't usually cause a problem on the first death is, once again, the spousal exemption. Leave your ISA to your husband or wife and it passes completely tax-free. But notice what's actually happening there. It isn't the ISA protecting itself, it's the marriage exemption doing the work. The instant that ISA passes to a child instead of a spouse, it sits inside the taxable estate exactly like any other asset. Here is the part that almost no surviving spouse ever finds out about, and it genuinely costs people real money every year through pure ignorance. When your spouse dies and leaves you their ISA, you become entitled to something called an additional permitted subscription. It is a one-off extra ISA allowance, completely separate from your normal yearly allowance of £20,000, and it equals the full value of your late spouse's ISA at the date they died. So say your husband dies with an ISA worth £75,000, you still get your own £20,000 annual allowance. On top of that, you get a separate one-off allowance of £75,000. That's £95,000 you can put into a tax-free ISA in a single year, keeping that protection fully intact. You don't even need to inherit the actual investment sitting inside the ISA. You just need to claim the allowance and use it. If nobody tells you this exists, you simply never claim it. And the window to do so is strict. 3 years from the date of death, or 180 days after the estate is fully settled, whichever is later. After that, the allowance vanishes. No extensions, no flexibility. If you've lost a spouse in the last 2 or 3 years and this is the first time you're hearing about this, stop watching for a moment and call your ISA provider. Ask them directly. My late wife or husband had an ISA with you. Am I entitled to an additional permitted subscription? And how do I claim it? Most providers know exactly what you mean. Most widows and widowers simply never thought to ask. I do want to be honest about what this allowance does and doesn't do. It protects the tax-free status of that money going forward, in your hands. It does not shrink your own estate when you eventually die. That value is still there, still counted, still potentially taxable on the second death. But claiming it costs you nothing and takes one phone call, so there's no excuse not to. We're about a third of the way through what I want to share with you, so let me pause and say this. If this is helping you see your own situation more clearly, leave a comment telling me which of these 4 assets you're thinking about right now. Not for the algorithm, although it does help. I genuinely read these, and knowing which part matters most to people watching helps me make the next video more useful. And if you haven't already, this is a good moment to subscribe, because the next asset I'm about to cover has a deadline attached to it that affects almost every working family in this country. That asset is the pension, and out of everything in this video, this is the one with real urgency attached to it. For decades, money sitting unused in a pension has lived completely outside the inheritance tax system. The reason is a bit technical, but it matters. Pension death benefits aren't paid automatically as part of your estate. They're paid at the discretion of the pension scheme's trustees, because the money technically isn't something your beneficiary has a legal right to under your will. It has never counted as part of your taxable estate. The practical result is that a pension worth £300,000, properly set up, could pass to your children with zero inheritance tax, not through clever planning, simply because of how pension law was written decades ago. I saw this pattern again and again throughout my career. A couple in their late 60s, comfortable but not wealthy, modest house, modest savings, and then one of them, often whoever was self-employed for years, has a pension that quietly grew to £280,000 or more over 30 years of contributions. On the first death, it passes to the surviving spouse, exempt because of the marriage rule. On the second death, it passes to the children completely outside the taxable estate. Clean, legal, and an enormous benefit to families who never thought of themselves as having significant wealth. That is about to change, and the date matters. From the 6th of April 2027, most unused pension funds will be brought inside the inheritance tax estate for the first time. This isn't speculation. The legislation has been moving through Parliament since late 2025, and the direction of travel is settled. A pension worth £300,000 that today passes to your children completely tax-free will, from next April, be counted as part of your taxable estate. If the rest of the estate has already used up the available allowances, that pension faces 40% tax. A bill of £120,000, where today there would be none at all. There's a second layer here that almost never gets mentioned, and it's worth knowing about, even though it's painful to hear. If the pension holder dies after age 75, beneficiaries already pay income tax at their own personal rate whenever they withdraw money from an inherited pension. So from next April, a child inheriting a pension from a parent who died over 75 could face inheritance tax on the pot itself, and then income tax on every withdrawal afterward, two separate taxes touching the same money. That isn't an accident or an oversight. It's a deliberate policy choice, and families who don't understand it will simply pay the price quietly, without ever realizing there was anything they could have done. There is some good news inside all this. The spousal exemption survives the new rules completely. Pensions passing to a husband, wife, or civil partner remain exempt from inheritance tax even after April 2027. So the picture on the first death doesn't really change. It's the second death, money passing to children and grandchildren, where the new rules really bite. Which brings me to the single most useful thing almost anyone watching this can do this year. Your pension has a form, sometimes called an expression of wish, sometimes a nomination form, where you record who you'd like to receive your pension if you die. It isn't legally binding, which is exactly what keeps it outside your estate today, but pension trustees take it seriously and almost always follow it. If yours is out of date, naming a parent who's passed away, an ex-partner, or simply left blank, the trustees end up making that decision themselves without knowing your actual wishes. And once your pension sits inside your taxable estate after next April, having your overall plan account for that properly becomes genuinely important. Call your pension provider today. Ask them this exact question. I'd like to update the expression of wish on my pension. Can you tell me how to do that? Most providers handle it online or post you a short form. It takes about 20 minutes. Given what's coming in 2027, it might be the most valuable 20 minutes you spend on your finances all year. Now, the fourth asset, the quiet one. The one that never feels significant on its own, which is exactly why it catches so many families off guard. Your everyday savings, current accounts, premium bonds, savings certificates, investments sitting outside an ISA wrapper. Individually, these feel small. Together, on the second death, they can push a modest estate well past the available tax-free threshold. This is also the easiest pot to reduce, using tools that cost nothing and need no solicitor, no financial advisor, just a bit of knowledge most people simply never had. Every individual in this country can give away £3,000 a year completely free of inheritance tax. No waiting period, no paperwork, no clock running in the background. It's exempt the moment you give it. And if you didn't use last year's allowance, you can carry it forward once, meaning up to £6,000 in a single year per person. For a married couple, that's potentially £12,000 a year passing to children or grandchildren with zero tax consequence, year after year. Over 10 years, that's £120,000 quietly removed from your taxable estate before any 7-year clock even begins. There's a second exemption that's even less well known and potentially far more powerful for couples whose pension income comfortably covers their living costs. Regular gifts made out of surplus income as part of a clear and consistent pattern can be entirely exempt from inheritance tax with no upper limit at all. The conditions matter though. The gifts have to be regular. They have to come from income, not from savings or capital. And they must not reduce your standard of living. Keep a simple written record what you gave, when, and the pattern behind it, because HMRC may ask to see it. Done properly, this exemption can shelter thousands of pounds every single year with no cap and no waiting period. Larger one-off gifts work differently. They start a 7-year clock. Survive those 7 years, and the gift sits completely outside your estate. Between years 3 and 7, something called taper relief gradually reduces any potential tax bill. The word that matters most in all of this is survive. The clock only starts the day the gift is actually made. A gift given today at 70 clears comfortably by 77. A gift given at 80, after a difficult diagnosis, after a bad fall, after a worrying appointment with a consultant, is a very different and much harder calculation. There's one boundary I have to be completely honest about. You cannot give something away and keep benefiting from it as though you never gave it at all. Hand your house to your children, but keep living in it rent-free, and HMRC can pull that gift straight back into your taxable estate under what's called the gift with reservation rule. The gift simply stops counting for inheritance tax purposes. This is exactly the trap people fall into when they try to be a little too clever, and HMRC unwinds it without much difficulty. If you're considering a larger gift involving property, speak to a proper estate planning solicitor first. But the small annual exemption, the regular gifting from surplus income, those you can genuinely begin today, this week, with nothing more than a decision. Here's something I noticed again and again throughout my career, and it has stayed with me. The families who lost the most money were not careless people. They weren't naive, and they certainly weren't unintelligent. They simply kept meaning to deal with it. The will review kept getting pushed to next month. The pension form kept sitting in a drawer, and then, for some of them, illness arrived before the paperwork did. HMRC was never in a hurry. It never needed to be. It only had to wait. So here is what I want you to actually take away from everything we've just covered. A married couple in this country can genuinely pass up to £1 million to their children without HMRC touching a penny of it. That is not a fantasy reserved for people with private accountants. It is written into the law, available to ordinary families exactly like yours, and it works exactly as described, provided 4 specific things are properly in place. The will needs to direct the home to your children. The pension nomination needs to be current. The ISA allowance needs to be claimed if it applies to your situation. The annual gifting exemption needs to be used while you're both still well enough to use it. That's the whole list. 4 items. Almost all of it is paperwork. None of it requires wealth. All of it requires action before it's too late to take it. If you only do one thing after watching this video, make it the pension nomination form. 20 minutes, completely free, and given everything changing in April 2027, genuinely urgent. For everything else, the will, the gifting, the ISA allowance, pick whichever one feels closest to your own situation and start there. Not all 4 at once, just one, then the next. I should say plainly, as I always do, I'm not a regulated financial advisor, and nothing in this video is advice about your specific circumstances. I spent decades working inside UK estate and tax cases, and everything I've shared comes from what I genuinely saw happen to real families, again and again. For your own situation, especially anything touching pensions or property, the right people to speak to are a qualified financial advisor, an estate planning solicitor, or PensionWise, which is completely free. If this video gave you something useful, even just one thing you didn't know an hour ago, do 3 things before you go. Like it, because it tells me, and it tells the algorithm, that this kind of plain English explanation matters to people. Subscribe, because the pension rules are shifting fast over the next year, and I'll be tracking exactly what changes and when. And share this with the one couple in your life who you know hasn't looked at their will in a decade, because for some families, the only thing standing between £1 million going to their children and a chunk of it going to HMRC is simply someone sending them this video at the right time. Look after the people you love, check the paperwork while you still can, and tell me in the comments, out of these 4, which one are you going to deal with first?